was scammed 40%.
My clients are telling me that the toughest thing.
Fannie and Freddie are now starting to trigger repurchase requests for the loans originated post-pandemic, with the huge penalties on the horizon in a bad economy making things even worse for the lenders. Majority of the current open real estate loans originated in 2021-2022 with low interest rates below 4% are now starting to be repurchased. Many service providers were overwhelmed by a huge value in underwriting, cutting costs and cutting corners in the origination process quality control to sustain the high volume. Some underwriters had no capacity and turned down many small originators and regional banks, causing them to settle for subpar underwriting. Paper is much cleaner now compared to GFC, but still some of the gray areas of underwriting was scammed. So what's the problem? GSEs have 3 years to review the loan for defects and compliance after the loan was purchased and securitized by GSEs at their origination. 3 years from 2021 and 2022 will put us in Q4 of this year through Q4 of 2025. If the loan was sold to GSE and it doesn't fit into GSE criteria, the repurchase request is triggered for the lender to buy back the loan and keep it on the bank's books with penalties and interest paid to GSE. Fundamentally, there are two major issues with that. First, the lender needs to have extra cash on hand to pay for the loan to GSEs as a part of the repurchase. Second, holding the loan on their books would only translate to cash back to the lender after the loan is sold on capital markets at the deep discount as a defective loan with low interest rate. This means the spread on the loss can be as wide as 40 points from origination to scratch and dent sale. Additionally, originators typically do not retain the servicer in-house and would need to hustle and sign up with a servicer to collect monthly payments from the borrower, transfer to different custodian, etc. All contributing to additional cash required for handling repurchase requests. Areas of concerns by GSE were DTI, debt-to-income ratio, self-employed income verification, unusual income streams such as crypto trading, NFC trading, 2 to 3 jobs of the borrower or co-borrower, property value, high-risk loans, and borrower credit scores. Per John Tuhig, which is my favorite guy on YouTube from Raymond James, the defective loan originated in 2021 and 2020 with 3.5% on average interest rate is now selling at 75 cents on the dollar. Loans were repurchased by lenders due to minor defect in underwriting are now discounted to 65 cents on the dollar. Housing Wire put out a report on 2023 Q3 looking only at Fannie Mae loans, the largest securitized player on the loans, and looking at the repurchase request as a percent of loans originated in the course of the year versus repurchase requests in total. So in 2020, 8 basis points were repurchase rate. In 2021, 11 basis points were repurchase rate versus loans originated. 2022, 40 basis points. 2023 through Q3 of this year, 68 basis points of repurchase rate requests. What are the solutions on the table? Well, some folks on the Hill are suggesting for GSEs to take on curative work on minor defects in-house instead of initiating repurchase requests. While originators would still be paying for extra expense by GSEs to cure minor defects, it'll cost much less to originators than actual repurchase requests. For future loan originators, they have to evaluate AI-powered post-origination QC solutions to check all data points without cutting corners, independent of future value, low or large. This is exactly why I personally invested and built AI-based due diligence platform called One Diligence. Would love to brainstorm with you at MBA Annual Conference or ABS East.